G'day, Ian Dooley here, Economics Advisor to the Australian Workers' Party. I'm here today with Chris Bedingfield from Key Global Investors. Chris, thanks for joining me.
Thanks, Iain.
Now, Chris, just if you could, where this interview is being done and broadcast on a political party website, so I just want to make it clear that you're not part of the party, you're not a member of the Australian Workers' Party nor an official supporter, but you've worked in finance markets for a long time, and I wanted to talk to you because I wanted to get the straight dope from someone who's not ideologically driven and not part of sort of any political organisation. So can you give us a bit of a background on your involvement in finance?
Involved in finance, banking and finance for 26 years. I've spent most of that time on the banking side, and what's happened over the last 2 or 3 years is I've left the banking side and started up my own business, which is a global investment management business with my business partner. So we are basically fund managers, and I guess my interest in the economic side of things is to ensure that because we're custodians of other people's capital, we don't really have much of a luxury for an ideology. It's important for us to get things right. So the economic framework that we often refer to in our process is very much MMT driven, which operationally is really about understanding the operational realities of the monetary system, not just here but also elsewhere in the world. And the Australian monetary system is remarkably similar to that of the United States, Japan, the UK, New Zealand, Canada, etc. So that's a bit of my background.
So I bet you didn't get caught out owning any Swiss francs when they removed the peg, right?
No, we were fine. We were fine. Although I do note at the time when the Swiss government pegged the currency, there was all sorts of talk of inflation and hyperinflation and goodness knows what else. Our view that Switzerland was going to continue to have deflation, and of course the reality was there was no inflation. It was in fact deflationary. So, which is what low interest rates actually do. It creates a deflationary environment. That's been Switzerland's problem for some time.
Yeah, that's always interesting. The fact that if you increase the interest rate, you're paying more money into the economy. Obviously, that's an inflationary. Low interest rates have the opposite effect. So it's almost like they've got the diagram upside down, right?
Yeah, the pundits have been, to their credit, have held that view in the face of reality now for some time. But it's only taken 20 years of Japan to, and people still aren't convinced. It's bizarre.
Yeah, that's right. So I just want to get some facts about what we refer to as government debt. It's bonds, the bond market, treasury securities. There's a lot of different names for it, but basically we hear people in political circles all the time complaining about debt. It always goes along with debt and deficit, so government debt and the sort of notion that we have to pay that back somehow. But also, I think the most important thing is that somehow the level of debt constrains how we can spend. That's the biggest issue, is that we have a lot of debt, therefore we can no longer spend any more money. What we were talking about just before, I wanted to rehash that. You said that yes, there is an operational requirement because of how our institutions are set up to sell bonds. The government has to sell bonds in order to spend. But the way that it's set up, there will never be a failed bond auction. Can you cover that off?
Yeah, sure. So essentially, when the government, the government operates its spending through the Treasury. The Treasury banks with the Central Bank, the Reserve Bank of Australia, and our bank and our financial institutions also bank with the Reserve Bank of Australia. And so operationally, what happens is when the Australian Treasury has to have a positive balance, a positive cash balance at all times. So when they spend their money, what they effectively do is they mark up the accounts of the recipients of that money. And let's say if it's a business that's bidding for government work, that business will receive the funds, so their deposit account will go up, and at the same time, the Treasury will transfer their money to the bank that holds that deposit on behalf of the company, and so the banks will actually get get the cash, extra cash in their RBA account. That cash is called an exchange settlement account, exchange settlement funds. And so that's the process. That the Treasury basically marks up the accounts of the recipient, and the banks receive the cash. Now the trick or the subtlety of what goes on is that the Reserve Bank manages the amount of cash that's in the system on any particular day. And if there's too much cash, if banks are holding too much cash in the system, the Reserve Bank will essentially penalise those banks by 25 basis points. So as a result of the Treasury spending that money, the banks in aggregate have got too much cash. They're looking for a place to put that cash, otherwise they get penalised. And so the issuance of bonds effectively allows the banks to put that money back to get a return, and by buying the bonds, they settle the money by the money going back to Treasury, and that cycle can go on forever. It doesn't matter whether that we had total debt of 100 billion or 200 billion or 20 trillion. The same mechanics. The mechanics are still the same. The spending is creating too much money in the banking system, and the banks need to get rid of it, so they have to buy the bonds to avoid the penalty.
So it's self-reinforcing. The desire for government securities or government bonds is reinforced by the fact that you're penalised for holding the cash, and every time the government's deficit spends, it issues new bonds and creates more cash.
Yeah, that's right. And and it's I know it sounds very technical, but if for the people that are watching this video, just step back for a second. You think about 2006. In 2006, we Costello and Howard had paid off the debt. We had AAA credit ratings, or the highest credit rating possible from all three ratings agencies. We had a few bonds on issue, mainly because the private sector wanted the bonds on issue for pricing and reference point. So you think back to 2006, we had budget surpluses as far as the eye could see. The cost of debt, the yield on government debt at that time was about 5.8%. Fast forward now 10 years, we've got total debt's almost $500 billion. The rating agencies are starting to talk about downgrading. We've got deficits as far as the eye can see, and the government debt is less than half of what it was when we had no debt. So
you mean the yield?
Yeah, the yield. So the yield today, looking at the screen today, I think it's about 2.7, 2.8%. It's less than half of what it was when we had no debt and surpluses. So, quite often there's this analogy that the government's the same as a household or a business. But I can tell you, by 25 years in business, people can't run up that sort of debt and have their cost of debt fall. It just doesn't happen. So there's something else that's been going on. And what does go on is exactly as I described. The money is being created through the spending, and then that money within the banking system has to find a place to go. Otherwise, the banks get charged a penalty, and the bonds are always bought.
So it seems then that the real key to this, if we want to trace this back to one of the core statements of modern monetary theory, which is really hard to ascertain because of this system we have of this issues of bonds and all this crazy stuff that goes on. It's quite it sort of blinds you with science. It's kind of hard to keep track of. So the statement that when the government spends, it creates money is hard to trace through all of these steps. But if we look at the fact that bonds really are basically money, they're term deposits at the RBA, and the government, when it spends, Treasury creates bonds out of thin air, then there's really no difference between saying the government creates bonds when it spends and the government creates reserves when it spends. Those two things are basically the same statement. Yeah,
they create money. And don't forget, when the government is running a deficit, the non-government is accruing a surplus. So just by virtue of accounting, what that means is the private sector, the non-government sector, is net saving. And so there's a natural home for the bonds anyway, by virtue of the fact that we are running a deficit.
Right.
So, the other analogy I like to use as well is whether you use, I think the point is right about bonds is really term deposits, it's a form of holding your savings. The analogy I like to use as well is, government is basically a ticket issue for like a concert, and you can't collect more. You can't collect the tickets unless you issue them first.
Right. Yeah.
It's a logical impossibility. The other thing you can't do is you can't collect more tickets than you've issued as well. So this idea of wanting to run surpluses, it can happen in in distinct periods, but at the end of the day, you just simply can't collect more tickets than you issue. So, and that sort of brings you to this point about inflation. If you end up using the analogy, taking it one step further, if a person has got 500 seats to sell to a show, and you issue 500 tickets, then the tickets have value. If you have 500 seats to the show and you issue 1,000 tickets, suddenly your tickets aren't worth as much. You not only need a ticket, but you have to get there a bit quicker. The value of your ticket is diminished, and that was what we would call inflation. And that really is the constraint. It's issuing too many tickets, or issuing too much money, or having too much net spending in the economy that starts to diminish the value of the currency. Now, if you look at the opposite, if you've got 500 tickets, and if you've got 500 seats and you're only issuing 200 tickets, the show's not really. The tickets have a different value again. You end up having a deflationary environment, and that's kind of where we are at the moment. In Australia, we feel like unemployment's too high and inflation's too low. This is evidence that the deficit is actually too low, that there's not enough spending that's going on in the economy. So the real constraint is always inflation, and inflation is, and that really is when the economy is really running at full tilt, and we start running out of excess or spare resources.
Yeah, and the notion that there was an article in the Conversation the other day from Professor Richard Holden at UNSW, and he stated as sort of an economic fact, this as if it was an axiom. He didn't have to reference it anywhere, that issuing reserves that weren't backed by bonds would be by default hyperinflationary at all times. So that if we reconfigured our legislation, if we changed the way our institutions are set up to use something like overt monetary financing, where the government just, instead of issuing bonds, issued reserves, that would somehow be hyperinflationary. But what you're saying is that there could never be a bond auction failure by the very nature of the sort of physics of money. So it's almost like that's the discipline must be coming from somewhere else. It must be coming from legislation already. So we are already disciplining our spending with legislation. There's no sense in which, if the market wasn't applying this discipline, the government would go crazy pork barreling and doing cash handouts to win the next election, because they're already not doing that. And they're disciplining themselves and us quite sufficiently based on legislation. So we could just write a different piece of legislation that did it better, right?
Yeah. I mean, this idea that, issuing reserves is inflationary has been, anyone that's paid any attention to what's been happening in the world for the last 20 years knows it's nonsense. The idea comes from the issue that the thinking is that banks lend out reserves. So if you have lots of reserves in the system, then the banks will have lots of this money to lend out, and that the money multiplier takes over, and you end up with a world full of cash, and therefore lots of inflation. And that's actually, and I can say this from a practitioner's point of view, that's not actually how banks lend. When banks lend, they wait for a creditworthy customer to walk through the door. If a creditworthy customer wants a loan and is approved by the credit committee, then that customer gets the loan. And the way they get the loan is the bank marks up their loan account and marks up their deposit account. So the asset and the liability goes up, bang, bang. Simple accounting process, got nothing to do with the central bank. And that's how loans are created. It's just double entry bookkeeping. And so you have as many reserves as you like in the system, but if you don't have creditworthy customers walking through the door, or if you don't have banks who are willing to lend, you're going to get no credit growth. And Japan is a great example of that. And the United States, after the financial crisis, they flushed the system full of reserves, and the credit growth was anemic.
The notion even of saying, like, those words, lend out reserves, reserves can't be anywhere except the RBA, right? Like, what?
Except within the what I would call internal money. Yeah. So the RBA and its customers.
So where would they go? I mean, that's the stupid thing is unless you're lending out these reserves and then everyone's instantly withdrawing them as notes and coins. How would you even say lend out? Because all it would mean is that they go to a different bank at the same RBA, right?
Yeah, I mean, at the end of the day, the RBA actually gives away a big hint here. They actually call them exchange settlement accounts. And so you have to sit down and listen and say that out very slowly, because the RBA is giving a hint. That cash, or those reserves, what we used to call reserves, but what the RBA calls exchange settlement accounts or exchange settlement funds, is to do exactly that. It is to settle transactions on behalf of customers, the bank's customers. So if I do a transaction with my business partner and he banks at ANZ and I bank at NAB, and I need to transfer money to him, NAB will move part of their exchange settlement balances from their account at the RBA to the ANZ account at the RBA. And that's the role of, if you give the banks more of these exchange settlement balances, it doesn't mean anything.
Yeah.
Just means that what it does mean is they get penalised 25 basis points by the RBA because they hold too many reserves.
Yeah.
That's all that happens. And that crimps bank profitability. And again, you just have to look around the world to see exactly the same problem. Look in Europe, where they've gone to negative interest rates, where banks are essentially getting taxed by holding reserves at the central bank, reserves that they have to hold because they are needed to settle customer accounts. And so bank profitability has been crushed by these low interest rates. And it's no surprise now that rates are rising, best performing stocks are banks, because they're now getting returns on their exchange settlement accounts or their reserve.
All right, Chris, thanks very much for your time. I really appreciate you taking time out of your work day here on a Friday to talk to the members of the Australian Workers' Party. And hopefully we can chip away at this and get some results at some point. I know it's going to be a long road before we actually get some economic sense coming out of the government.
Yeah. Well, thank you for the opportunity, and good luck with it all.
All right, thanks a lot. See ya.
Cheers.